Hello, good afternoon, and welcome to this our final webinar for 2025. And if you're joining us for the first time, a very special welcome to you. I am Dr. Sandra Palmer, CEO of Above or Beyond. And today I'm happy to present our co-sponsoring partner, Turner Surety and Insurance Brokerage Incorporated, represented here today by Mr. Anthony Amicucci. Before I introduce Anthony, I'll just share a little bit about me. Anthony is this main speaker today, but I'll just share a little bit about my work at Above or Beyond. Okay, so at Above or Beyond, I have been working with construction business owners for almost 25 years. And I help these business owners to move beyond survival to build scalable, profitable, and sustainable businesses. And through this work, construction businesses transform their organization. It helps them to equip their leaders to close growth gaps, to implement the right systems and processes, and lead with confidence. I'm currently also a construction executive business coach with Columbia University. And I'm happy to share that I was also named one of the top female entrepreneurs in the Americas by the World Bank. Now, let me introduce to you our main speaker, the man of the hour, Anthony. Anthony Amicucci. Anthony is a seasoned insurance broker with close to 2 decades of experience in the construction industry. His experience consists of OCIP, CCIP, and project-specific policies for large construction projects, 100 million and plus. He also works with customized renewable programs for trade contractors. He is very passionate about advocating for increased opportunities for small businesses in the construction space. He works closely with various state and federal agencies tasked to identify and provide support to businesses interested in working on large construction projects. From volunteering to teaching at construction management schools to private speaking engagements, Anthony works directly with small business owners to educate them on key construction and insurance trends and to provide resources needed to qualify and bid on large construction jobs. This includes increased insurance coverage and limits, surety bonding capacities, startup contract financing, and new business opportunities. He has so much to share with us today. Please help me welcome Mr. Anthony Amicucci.
Thank you, Dr. Sandra. Okay, so let me just share my screen. Sharing is not turned on, so I'm sending Tony the request so I can share my screen. Yeah, my name is Anthony Amicucci. I've been an insurance broker in the construction space for almost 20 years now, and I work for TSIB, Turner Surety Insurance Brokerage, and we are the sister company to Turner Construction. So Turner created our company back in 2000, and the purpose was to manage the insurance and bonding program for Turner and the family of companies. Turner, Flatiron, EE Cruise, this is about 30 billion plus in construction volume. And after that was up and rolling, they created our team, which leverages all that buying power we have in the market and provides these services to businesses outside of the Turner family. So, as Dr. Sandra said, I have a book of business with trade contractors that are as small as doing 500,000 a year, upwards of over $100 million a year. So, the presentation we have for you today is about managing your insurance program. And it's less about definitions and more about things that are in your control. So hopefully by the end of this, you have a better idea about how to go about handling your renewal and different levers that you can pull to manage your cash flow, because getting the insurance is one thing. There's only so much that can be done about price, but it's really how do you manage your cash flow and keep up with these premium programs. So premium payments. With that, I'll dive right into it. Okay, so state of the construction market. And Tony, you let me know if you can't see anything or you can't hear me, just pause me throughout if that happens. Um, so state of the construction market, challenging but manageable. I used to have chaos written up here, but it's pulled back a little bit. Um, and really let's take a step back and look at the insurance industry as a whole. Insurance carriers aren't quite making the money like they used to. And this is driven by uh, really weather-related claims. Wildfires in California, every hurricane season is the most active on record. Flooding, tornadoes, all these types of things come into play and affect the bottom line of the insurance carriers. Then there's, inflation, tariffs, costs, all these types of things carriers as a whole are making less money. So when they evaluate their books of business, construction is often the first that's going to be affected by this because it's more risky than other things that they are insuring. So uh, this is how it can affect, yes, you might have good claims history, never had a claim, but your price goes up from these other factors outside of what you're doing. And because of this, there are limited markets than there have typically been in the past. So there's direct markets, admitted carriers like the things you see on TV, Geico, Hartford, Liberty, Zurich, Travelers. Uh, Brokers go directly to these markets and they get the quotes. And then separately, if you're in specific markets where insurance is more expensive and more difficult to write, you're in the excess and surplus lines market. This is typically found in the New York area. And these carriers exist when the Hartfords of the world don't want to write the business. So there's less markets available for quotes than there have ever been before. And the markets that are there, they have less underwriting capacity. So what does that mean? If I'm an underwriter and last year I was able to issue 100 insurance policies, this year, I'm only allowed to issue 70 policies. They're shrinking my underwriting capacity. So this turns into a simple supply and demand. There are more submissions to the markets that are writing good coverage and good pricing, and there are fewer quotes being issued. So it's extremely competitive to get the good carriers to offer you a program. And this makes broker carrier relationships extremely essential. A theme of this presentation will be you really need to have a construction focused broker because these underwriters, they have a stack of submissions on their desk a mile high. They can't get to all of these submissions in time. So they're first going to read the ones that are given to them by brokers who submit to them the most business on a consistent basis and it's most profitable. So the more construction focused of a broker you have, the more volume of construction insurance they write, the better responses they're going to get from the underwriters who are offering that good coverage. Many small businesses are working with mom and pop type brokers, local small brokers that do all sorts of things. Maybe they do some construction, but ones who are doing exclusively construction, they're always going to get you better results. A general rule of thumb for cost is 7% of your volume, your annual gross sales should be set aside for general liability, workers' comp, and excess coverage. I have some clients who pay 6, 7%. I have some who pay 22%. It can really vary that much. If you're well below 7%, you likely have some sort of coverage gap, some sort of exclusion. Um, and if you're well above that, this could be a number of different factors, your experience or your claims, anything like this. So, but 7 to 10 is that range of where you should expect your insurance costs as a whole to be. So ultimately, if you're not a top shelf submission, you're not going to receive that competitive quote. What are the elements of a top shelf submission? I always say, don't just submit your numbers. If you're just speaking to your broker once or twice a year and they're giving you an application that you send in and you wait for a quote, yes, that can get you coverage, but this is not a sustainable strategy that you want to continue to do as you grow. These are the types of things we put into submissions for our clients or prospective clients. like you're responding to a bid, an RFP. You want to be detailed. Our goal here is to sell the underwriter on your business, why they should be insuring you at a good price. Executive summary, narrative of company history and growth strategy, highlighting resumes, not just for the owners. Maybe you have project managers who have been working in the business for 30 years. Maybe you have safety people. The more information you can provide to the underwriter to get them comfortable with who you are and how you operate your business, the more excited they are going to be to issue a quote. So there's no such thing as overkill. Give as much information as you can. Work in progress list. This is mandatory. If you can go out 24 months, that's amazing, but it at least has to have what you're going to do over the next 12 months. And this WIP list should include what is the job? Where is it located? What are you working on? Is it a house? Is it an apartment? Is it a hospital? Is it a stadium? What is your scope of work? Be detailed. What is your direct payroll on the job? Break the payroll down by class code. If you sub out work, what are you subbing out? How much and what classifications? And how long is the job? And how much of it are you going to perform in the next 12 months? So these are the type of things that should be supporting that supplemental application. Claims breakdown analysis and trends. Everyone's going to have claims. Carriers charge you, to cover those claims. If you haven't had claims, what is your response plan when claims are incurred? The tricky part about claims is there's a statute of limitations. If someone gets hurt today on the job, they don't necessarily have to file that claim right away. They have to file workers' comp right away, but they can also file general liability 2, 3 years down the road. So good lawyers are going to catch these employees when they fall and coach them up on how to get the most out of that settlement. So your project managers should have a response plan. When these claims happen, we quarantine the area, we take photos, we interview the employees that are on site and save this information. People you employ today might not be working with you in 2 years, so you're not going to be able to go get that statement at the time. So explaining to an underwriter how you will respond in the event of a claim, and if you've had claims, what you've learned from them and what you've changed to prevent them from the future. These are the types of things the underwriter wants to see to know that they are ensuring reasonable business. And they want to insure you for multiple years. They don't want to be one and done. They want to keep renewing you over and over again. So, the last thing I say is propose your own program. We try to give the underwriter a real specific target. Hey, the rate on the policy last year was $10. Here's why I think it should be $8.75. Don't ask for something unreasonable. No one's just going to give you a 30% reduction, but give them a full, detailed submission with evidence and reasons why and a target why you should hit that number. This is the approach your broker should be taking when they're renewing your policy with you. Next slide is reporting exposures. Think about what you report. This is the main lever you have to affect your premium. I said at the beginning, getting the coverage and the cost, there's only so much that can be done there, but it's managing your cash flow and keeping up with those premium payments. There's a 25% minimum earned premium. You're on the hook for 25% of your premium the day you bind that policy. And every policy is going to be audited at the end of the year. 9 out of 10 policies are going to be audited. Sometimes you don't get audited, but the carrier is entitled to audit you every time. And if you exceed the sales that you report $1 million, you do 1.5, they're going to charge you an additional premium for that 500,000 in sales. If you do 800 and you reported $1 million, they're likely not going to give you money back. It can happen, but it's very rare. So let's go through an example of, let's say you project you're going to do $1 million over the next 12 months. So just because you project $1 million doesn't mean you have to report that. I'll speak with my clients and I'll say, they'll say to me, I have a job my payment has been delayed. I'm not going to receive payment on this job for 90 days. I'm concerned about keeping up with the premium payments because of the delay that I'm going to receive. So in that instance, you think you're going to do 1 million, you can report 800,000. This is going to give you a higher rate on your policy, which means when you get audited, you're going to have to pay at that audit at that higher number, at that higher rate, versus reporting $1 million. They're going to give you a higher rate on the policy, meaning your premium is going to be more, your down payment is going to be more, your 12-month premium payments are going to be more, and but your overall cost of insurance is going to be less because in the first example, if you did 800,000, you're going to pay less as a down payment. You're going to have a lower monthly premium bill, but you're going to have a higher audit. You're going to have a higher rate. You're going to have a higher audit, but you can spread these payments out because when your policy term ends, they'll likely contact the broker and you for an audit maybe 3 weeks later. You take a couple of weeks to send the audit paperwork in. You ask for a payment plan. You dispute the audit. You can stretch that audit bill out for 6 or 8 months. So now you're still paying for the $1 million of work that you did, but you're going to pay more. However, you're spreading those payments out to 12 to 18 months versus paying less in a 12-month period. So sometimes it's in your best interest to report less and pay a little bit more than it is because you're spreading these payments out if you know you're going to have delays. So this is another thing that I'll talk to with my clients before these policies renew and we report the exposures to make sure we're not falling behind on cash flow. To further this theme here about cash flow, important dates. The date you sign the contract is not the date you start the job, is not the date that you receive your first payment. So you want to do your best to tie that payment schedule to your construction schedule. These are reasons why you'd want to report less than you project you're going to do. If you have to finance the policy is going to have finance charges and interest rates. Don't ever accept the first finance agreement that's given to you. Don't accept the first interest rate. We always ask for we always ask for a lower interest rate, and they always give us a lower interest rate. It happens all the time. So, and again, having a construction focused broker who writes a lot of business with the finance company, they're going to get this leeway, these exceptions more often than not. I've never had them tell me we're not going to lower the interest rate. So having more construction focused broker is going to help you do this. And if you're in an instance where you're delayed and you can't make a payment, you've got more time than you think to actually make that payment. So I always encourage everyone to be on time with payments. If you're late, carriers keep note of this. They might decide to non-renew you because you're late on payments throughout the year. But if this is happening, there are very specific laws on how they're allowed to cancel your policy. So if you have a bill due December 1st and you don't make the payment, the broker, myself, I'll get notified 2 weeks later, 3 weeks later, hey, your client missed this payment. Can you follow up with them? I send you a note, hey, you're late on this payment. Can you please make it? You still don't make it. Now the bill was due December 1st. Now it's January 1st. And they send you a notice of cancellation. That notice gets mailed to the insured. It gets emailed to the broker. And upon receipt of that notice of cancellation, there's another 30 days to make that payment. And then that 30 days expires. Then there's a 10-day grace period. So a December 1st payment, you can technically get by on this until the end of January to make that payment. So, again, I don't recommend this, but there's more time than you think to get by on these payment plans. And the other thing I'll say is underwriters don't want you to cancel for non-payment of premium. Underwriters are almost like small business owners. They have a book of business and they get judged by the profitability of it. So when an underwriter gets their year-end review from senior management, they're going to say, why are you writing companies that are canceling for non-payment of premium? This is not good underwriting that you're doing. You shouldn't have wrote that business. So underwriters I've seen this with experience. They go above and beyond to keep your policy from canceling. They'll reinstate it. They'll give you the benefit of the doubt because they don't want to see it cancel. It's a headache for them. So, just kind of tricks of the trade here on payment plans and keeping these policies active. Experience modification rating, EMR. So this relates to workers' comp. It's a rating that captures your workers' comp claims experience. It's got a 3-year look back. So once you're in business for 3 years, in year 4, you're issued an experience mod, which is based on years 1, 2, and 3. Year 5, you get a new experience mod based on your experience in years 2, 3, 4, and so on. It has a positive or negative impact on your workers' comp premium. If your EMR is 1.0, it has no impact. If it's 1.13, it'll have a 13% increase in your workers' comp rate. If it's 0.87, you're going to have a 13% decrease in your workers' comp rate. And it generally indicates a trend towards general liability claims. So workers' comp covers medical bills and lost wages, but employees can also sue for pain and suffering, and that happens after the fact. So if you have no claims on your general liability in the last 5 years, but in the last 2 years, you have 5 workers' comp claims, the carrier is going to see that this is going to trend towards general liability claims. So GCs and insurance carriers are looking at this experience mod more closely than ever before. And most of them have a hard and fast rule. You can't go on site if your EMR is 1.0. You can dispute your EMR. So I have 2 clients right now, their mods went over 1.0, for the first time in 10 years, and we conducted a review. And we found out that the EMR, it's a very complicated math equation. A lot of things go into it. It's generally driven by claims and your payroll. The more payroll you have reported, the fewer claims, the lower the mod. So these clients that I've had, their mod went way up, but we found out that they were not counting the correct payroll numbers in the calculation. So we pull the payroll audits, we write a letter to the insurance carrier, petition to get the mod reviewed and lowered and provide the evidence. And the carrier lowers the EMR. So your broker should proactively be reviewing your experience modification rating and identifying if there are errors with it and trying to help you drive it down. This should be done at no cost to you, the client. Brokers get commission. If they're just renewing the policy every year, they are not earning their commission. They should be doing more for you, like this that I'm describing here, these EMR reviews. Okay, we're coming towards the end here. The next 3 slides are how to calculate your insurance cost per project. So this here is the formula. We'll go through what it means, and then we have some examples on the next slide. So you can use this every time you're bidding on a job to make sure you have the correct cost of insurance in these bids. Exposure divided by rating basis times rate equals your premium. So your exposure is going to be payroll or sales. For workers' comp, it's always payroll. For general liability, 9 out of 10 times, it's going to be based on sales. One is not better than the other. Having it based on payroll versus sales, it doesn't matter. Whatever the carrier wants to do is fine for the client, in my opinion. Rating basis, if the exposure is payroll, it's going to be per $100 of sales. If the exposure is of payroll, excuse me. If the exposure is sales, it's going to be per 1,000 of sales. And lastly is the rate, state carrier company. The one rate you have on your policy, your GL policy has a rate, your comp policy has a rate. It's comprised of these 3 things. So let's say you're a plumber in Colorado. The state of Colorado is going to have a rate for plumbing based on the claims that the state sees in the state of Colorado. The carrier is then also going to have their own rate based on the book of business that they have for plumbers in the state of Colorado. So Hartford might have a $10 rate for plumbers in Colorado, but Travelers might have an $8 rate because they have better claims experience for that class of business in that state. And the last factor is you, the company. The claims experience that you have is going to impact this rate as well. So here are some examples. This is a general liability rate page, and then the highlighted numbers are at the top are examples of the formula. So if we look at the rate page, you see the exposure basis is gross sales. Units of exposure, 600,000. This company was projecting 600,000 of work in the next year. So, and the rate was per 1,000. So we look at the top right, we see 600,000 divided by 1,000 times 125. 125 is the rate on their policy, equals 75K. So this person's GL premium was 75K for the year. He comes to me 4 months into the policy. Anthony, I'm bidding on a job. My cost for the job is 257,000. What's my cost of insurance on this for this job? 257K divided by 1,000 times 125 equals 32,125. So he needs to add that 32K on top of the 257,000 for his cost of the work. That tells him his GL cost. He also has to do this equation for workers' comp. He has to look up the rate on his workers' comp policy and do this calculation. It stays the same. You just change the rate and you just change the exposure. So I tell my clients to contact me every time they're submitting a bid, and we run through this calculation together. It takes 60 seconds, less. So your broker can be helping you do this as well. Here's an example of a multi-rate policy. So this is a contractor out of New Jersey. They import steel from overseas to their warehouse. They fabricate it in the warehouse. They ship it on a truck to the project sites, and then they install it at the project site. They work in New Jersey. They work in New York, New Jersey, Connecticut, and Pennsylvania. So he's got 3 different rates on his policies. You go all the way to the bottom, you see $3.25, 27 cents composite rate. You go to the left, that says per $100 of payroll for fabrication. So when he fabricates the steel product, he's got $2 million of payroll exposure. His rate is $3.27. You go up to the top, you see $8.15. You go to the left, you see installation, all other states. You go below that, you see 5723. You go to the left, it says payroll installation New York. So he's got one rate for his installation work in New York. He's got another rate for installation in all other states. So wherever he's doing the job, he takes that payroll amount, and you see the highlighted on the left at the bottom, 2.5 million divided by 100, not 1,000 because it's payroll, times 815, 203,750. That's his premium for general liability when he installs work in all other states but New York. You keep going down the list, 700K divided by 100 times 5723 equals 400,000. The cost of insurance in New York is much higher than anywhere else for specific laws that they have. And his cost is 400K in that state versus 65K for the fabrication work. And on the right, those are some more examples if they were to be bidding on a $600,000 job. So it's a simple formula. It never changes. Your rate is going to change. When your policy renews, you want to see the rate go down. The more sales you report, the more payroll you report, the lower the rate you're going to have. So your premium might go up every year, but if your rate is going down, that's what you're looking for. That's what your broker should be pushing for. And lastly, how can we help? I'm available for one-on-one virtual meetings. Please send me an email. We'll do a 30-minute virtual call. We'll review your policy, review insurance requirements you're looking at, make sure you have all the right coverages. We'll review bid documents to make sure you're helping with the correct insurance cost, help you communicate with primes. Procurement people don't really understand insurance all that well. We talked about those cash flow issues with payments being delayed. I've successfully had primes put into contracts. The job doesn't start for 90 days. You want my certificate of insurance today. You must pay me $1,500 a month before the job starts so I can keep up with this payment plan. The prime also does not want to have to replace you for falling behind on insurance payments. So having your broker help you communicate these challenges with the primes can go a long way. Bonding support, we talked about insurance today. We have a bonding department. Bonding is all about your financials, certified financial, reviewed, audited financials. This is important. You have to have a lot of cash on hand. Uh, if you're looking for a bond for the first time, or you need to expand your bonding line, we can connect you to the bonding brokers within TSIB and help you expand that. And intros to our clients, good construction brokers, they have a lot of GCs. They have a lot of primes who are hiring smaller businesses. It's in my best interest to see your company grow. When your sales grows, your premium grows, my commission grows. So we are aligned. And ask your broker for referrals for contractors that might want to hire you. Um, you know, I'm surprised brokers aren't more proactive about this. So construction focused brokers should be. And anything else you might need. So that's it. Here's my contact info. We have a few minutes for questions here, but please reach out to me and we can meet one-on-one and talk about your specific situation. And that's all I have for you today.
Thank you so much, Anthony, for sharing such great information. We're going to now take some questions that were sent to us. So Tony will go ahead and
I see a question here in the chat. I can jump in and take this. What are the top variables that actually move insurance premiums for small and mid-sized contractors? And which of these can owners control immediately? It's the worst thing, the hardest thing is when you're a small business because the premium is inversely proportional to your revenue. So the less revenue, the carriers all have minimum premiums, meaning for them to write business, no matter how much work you do, the price starts at $10,000 a year. So if you report to them, you're going to do $200,000 in work or $600,000 of work, they're still going to charge you that 10K. And your rate's going to be a lot higher if you're doing less revenue. So, what's going to move? It's not so much what's going to move your premium, it's what's going to move your insurance rate. And honestly, it's just time. Uh, your experience mod is one thing. For workers' comp, improving your experience mod, this is going to have a direct and immediate impact on your rate, your workers' comp rate. So you should have your broker conduct an EMR review right away. Otherwise, it's really just how much revenue you're doing. The more you do, the rate's going to go down and the premium's going to go up. That's really, and then maybe there's a market that you haven't looked at that offers better pricing. So, you should have your broker shop you a little bit every few years. It's good. Underwriters like to see loyalty. They like to see that you've been with one carrier for more than 1 year. Um, but yeah, there's not a whole lot that can be done for a small business. You have to just grow. And then as you grow, you can start doing things with your deductible, take on more risk. And the more deductible you take, the less premium you're going to charge. There's a follow-up here um, about OCIP and CCIP, which is the other thing that you can do. So for contractors who have never participated in OCIP, CCIP programs, what are the realistic benefits and the pitfalls? There are only benefits. How do you impact your premium? You only do work on OCIPs and CCIPs. An OCIP is one insurance policy that covers an entire project. They're buying insurance in bulk. It's really for mega jobs. The jobs have to be, roughly $200 million or more. When that's the case, the owner or the GC, they can go to the carrier and buy one policy in bulk for everyone, and then all the contractors enroll onto it. So when they buy it in bulk, it's going to be cheaper. It's going to be 4 or 5% for that whole job versus every subcontractor who might be paying 7, 8, 9, 10%. So the cost of insurance for the owner of the GC, it's going to be less. The coverage, they're going to be certain about the coverage. There can be exclusions when you get to lower tier subcontractors, anyone really. They could have policies with exclusions in it. And, it's a lot of work for an owner or a GC to request a copy of everyone's policy, to really read it and see what's in it. So it's in their best interest to buy these OCIPs and CCIPs. It's cheaper price, it's better coverage, and it's higher limits. How does it affect the small business owner? If you do $1 million a year in work and 600,000 of it is on an OCIP or a CCIP, you are only reporting to your insurance carrier the 400,000 that is not on the OCIP and CCIP. You're only paying premium on the work that you're doing that is not on the OCIP and CCIP because that's what your policy is covering. Your policy doesn't cover a claim that could be incurred on that OCIP or CCIP. So there are no pitfalls. If there are SIP projects that are on your radar, you should be aggressively bidding on these. It's going to help control your cost of insurance. And we're starting to see, more of this because it's such a better product. Hopefully they can start working for jobs that are less than 200 million. In some states, in some instances, it can. But for now, it's really these mega jobs. But um, it's a great question. There's only benefits and there's very little pitfall, is what I would say. I hope that answered your
Okay,
question.
so I have one question here. So it reads, what early warning signs inside a contractor's operations indicate that premiums will increase at renewal?
Claims, you know, if your policy runs from January 1st to January 1st, 2025 to January 1st, 2026, and you have accidents in February and March, they're not impacting your premium right now in this current term, but it's going to impact your premium in the future when that policy comes for renewal. So when you renew, they ask for loss history, your loss runs, and they want them valued. They want them ordered within 90 days of the effective date. So if you have claims in the past that you have incurred and they're still open, I would request those loss runs every 6 months. And you want to look at the reserves. How much is the claim reserved for? So it might say, when you read it, it might say, we've paid out 50,000, but there's a $400,000 reserve on this claim. So we'll use that January 1st renewal date. If they order the loss runs in December and it says $50,000 incurred and a $100,000 reserve, they're going to charge you a certain premium. Now it's June, so it's the middle of your term. You order the loss runs again, and you see that reserve increase from 100K to 400K. That means your rate is going to go up. So if you're going to do more revenue, you're going to pay more premium, but again, your rate's going to come down. If you don't have claims and your revenue goes up, your rate should come down. So now your cost of insurance is not going to be 10% of your sales. It might be 8.5% of your sales. But the real thing that's going to indicate the increase is the loss runs, any claims that are incurred, any new claims that are incurred, or any old claims that the reserves have increased. If you're subbing out work, don't just collect certificates of insurance for these subs. you need to collect full copies of the policies because the cert doesn't tell you anything. It tells you carrier, date, limit. It doesn't tell you what's on page 76 of 148, where everything's excluded. Height, injuries, this and that. If you're subbing out work, you want to collect full copies of the GL policy. You want your broker to read those policies and tell you in writing, this is good coverage, or here are exclusions that, are problematic. Because if your sub has a claim and that policy denies the claim, now your policy has to pick it up. And then your premium's going to go up, your rate's going to go up. So that's important to look at.
Okay.
See,
Okay. Thank you.
Andy's has a hand up.
Yeah.
Thank you for that, Anthony.
Yeah.
Yeah, Anthony can speak to the costs to your premiums, but the things that I notice when we work with small businesses, really understanding the insurance requirements before you bid. So to understand what the project is requiring, what the cost of your program will be for that project, and how that revenue from that project will increase your your audit a year from now. So when you get some bid request from a contractor, you need to make sure that in that bid request is any information about what the insurance requirements are for that project, because your bid has to include not only the cost of your premium, the cost of the change in your future audits, but the administrative support you're going to need to manage all the work that goes with that. So that's just my 2 cents.
And also that brings up a good point. If you project you write your new policy based on $1 million of projected sales, and then halfway through the year you land a big contract, and now you're going to do $3 million, you can go back to the carrier and say, hey, look, here's a new contract. I'm going to blow my number out of the water. Can you re-rate my policy? And you'll have the initial rate for the initial million, and then they can give you, excuse me, a lower rate for the next 2 million. So we've had success in negotiating midterm if you're going to really blow that number out of the water, and this is going to help lower the cost. So again, good construction brokers are going to do this. They're going to check in with you. Are you exceeding your numbers? The things I'm talking about here are the types of things that you should be working on with your broker.
Okay. Thank you for that. I have another one. So, what financial practices or reporting habits fast track bonding approval?
Having a construction CPA is vital. Having certified, reviewed, audited financial statements from the construction CPA. This is like the holy grail for getting bonded. And these construction CPAs are going to have relationships with surety underwriters. So when that familiar CPA is submitting these financials and trying to get you bonded, they're going to have more success. Cash on hand and certified CPA, construction CPA, audited financial statements are the two things that drive everything with bonding. The SBA has small business bonding programs, which, go to a certain level, and you don't need much in terms of those audited statements. But if you're really growing and you need larger bonds, people don't like paying. It's hard for people to make that initial jump to the certified CPA, construction CPA, and pay for those statements. But it's vital. It's essential, in my opinion.
Okay, thank you.
Yeah, after follow up to that, if you can hear me, Anthony, a lot of small business owners ask about getting bonded. Why is it so difficult if you have to prove yourself before? So it's like a catch-22. So they can't get the bigger jobs because they're not bonded, they don't have the insurance. They can't, but on the other hand, it's hard to qualify to get it.
You broke off a little bit at the end there. I think the question was, how do small businesses are being asked to be bonded before they bid on the job. you have to get pre-approved. And then the bonding company will give you a letter that says this company has been approved for a bonding limit of $1 million, 750,000, $2 million. So you got to go through. Bonding doesn't happen overnight. For insurance, you have a renewal in 3 weeks. You don't like what the broker's doing. You want to use somebody new. You can do it quickly. Bonding is not quick. If you're thinking about jobs that require bonds, get the CPA today. Start building that relationship with the surety company. Surety companies don't move fast. So start the process early and don't rush them. When you rush them, they're just not going to do it. So make sure you have enough time and you've got the right people going to bat for you in the market. So growth is really a function of ability to get bonded and insurance. Bonding is much harder. Insurance you can get. It's never a struggle. I mean, sometimes it is, but insurance you can always get. Bonding, it's much more difficult. It requires a lot more, and you know, many jobs require bonds. It's correct. It's to really grow fast. The larger bonding line you have, the faster you're going to be able to grow. And you might have a $1 million bonding line, but you can't do $5 million of work on that $1 million bonding line because the bonding line is used up once you do it with one job. So it's more complicated. And yeah, it's trickier, it's more difficult than insurance. And if you're really trying to, if you're in that $20 million a year range, you got to expand the bonding line as much as you can. The more bonding you can do, the more work you can bid on, the more things you can do at the same time. I see another question here. When an
Thank you.
accident happens on a job, what is the thing a contractor should do to protect the company legally and financially? You want to have a good response plan. There's only so much that can be done. I mean, invest in safety. The bigger the company is, whether it's a prime or a GC, the larger they are, the more they are investing in safety. You might not see an immediate return on that dollar, but like the minute you have one claim, your premium's going to double, the premium's going to triple. So having a good safety plan in place, safety talks every day, orientations, training, these types of things aren't the first things small businesses do, but the large ones, they do it thoroughly. So having a good safety program and even giving some incentives for your staff to not have accidents can go a long way. And then when the accidents do happen, you know, you want to make sure you take photos, notes, interview your people on what happened there, gather evidence, so you can give this to adjusters and attorneys who are on your side to defend you here. Yeah, that's really. I'm trying to think what else.
That's a
Something
great
just.
point, Anthony.
Yeah, go ahead.
Because if you have an accident on site, and if you don't take those notes immediately, that employee will be gone and that claim might not come up for 2 or 3 years.
Yeah.
All that gets lost. So you need
The
to
other,
have it fresh in your mind and you need a
yeah.
statement.
The other thing that I just remembered it now, being particularly on workers' comp, being kind and responsive to the employee. Hey, I'm here for you. What can I do? Do you need help? Do you need this? Workers' comp claim advocacy, having people just reaching out to the injured employee and helping them in any way that they can. This is going to make the employee less likely to sue. That's that. This is a big component of like for Turner when they have workers' comp claims is advocating for the employee on their behalf and just being there for them. That kind touch does go a long way. I've seen it. We have resources on our team to do specifically this. trying to, and then good return to work programs. If they can't do, they get injured, they can't do X, but they can do Y. Getting them back to work uh, in some capacity is a helpful thing.
Okay. Okay, thank you so much. We'll take two more questions. Just two. Are there common claims patterns in construction that small contractors consistently underestimate?
It really depends, I guess, on the class of business that you're in. Nothing is jumping to my mind, but I'm not, honestly, and I've had all of these in all of my years. There hasn't been I haven't dealt with tons and tons of claims. I had a company that was a client that was a maintenance company, and they had a ton of slip and falls. This was a major trend for them. So every class of business is going to have, uh, specific trends and common claims. We can meet one-on-one and talk about this with the claims person on our team. I would even say just go to like ChatGPT. I'm a plumber. What is a trend for claims that you see? You probably get
Yeah.
amazing information just from that. So it's really going to depend on the type of work that you're doing. Um, I, lifting things, this is common. Pulling muscles, back muscles, this is common that I see. And like all you can do is train them on how you should lift. Um, maybe you want to buy PPE, goggles, gloves, helmets, buy this for your staff, back braces for people who are lifting things, those belts to help them lift things, tying down people to the scaffolds. So these types of things are the most common uh, precautionary stuff that major GCs are doing. But if we connect one-on-one, I can do a little bit of homework on your more specific class and give you some more information.
Okay, sure, that would be great. All right, so the final question, not sure if I had read this before, but what are the most common mistakes contractors make in their submission that cost them competitive quotes?
Just not like I described on that slide. If you're just filling out an application and submitting it, you're going to get a quote, but the underwriter's not going to like be aggressive to offer you something. Going above and beyond and giving the underwriter, the broker's job is to sell them on you. Here's why you should insure this company at your best price. So number one, not having a construction focused broker who's writing a ton of construction business. I came to TCIP in 2017. Prior to that, I worked for a large brokerage, but they wrote a bunch of stuff. They did a lot of construction, but they wrote restaurants and retail and trucking. A portion of their business was construction. When I came to TCIB, where we have Turner, as a client and their family of companies, and we're writing 30, $40 billion of work a year, this gave me way more influence in the marketplace. I get higher up in the food chain at the insurance carriers, and they are more aggressive because they want to keep us happy, because they want to continue to write Turner and make us do good work for us. So having a construction broker is the most important thing you can do. And they're likely going to give you better submissions, ask you better questions, and sell you better to the market. So what's the most common thing is having a local small broker who does a lot of different stuff and not just only construction. That's the biggest thing, in my opinion.
And there are a lot of programs depending on where you live. Like I've been in multiple states where local organizations have programs where my accountant who I've had for 20 years, I met when I was a WBE. And I went to a free seminar about accounting practices. She helped me set up my chart of accounts. She helped me organize my whole company, for no more than a regular accountant would charge. And although I have a small business, I still use the same accountant at the same price.
Hey, thanks, Andy. Right now, we have reached the end of our webinar. I would just like to thank Anthony and Anders for this wonderful presentation. It was well received, and it's definitely safe to say everyone learned something.
Yeah,
Uh,
thank you.
Dr. Palmer left a note in the chat. Thank you all for participating. Such great information. Anthony, you're fantastic.
I appreciate the
He
kind
is.
words. Please send me an email, connect with me, and I hope to meet with you all in the future.